Before we start, if you're interested in Bitcoin and blockchain, please consider clicking that subscribe button and also click the bell so you can get notifications about future videos that I might post. Thank you. Hello and welcome to the MikoBits show, and I am your host, MikoBits. Today I've got Nodar Janashia, who is an expert in decentralized finance and is working on an exciting company of his own in this space. So before we leap into here, I do want to say that this is an opinion-only show. It's for information and entertainment only. It's not intended to be investment advice. So check yourself before you wreck yourself. So as far as DeFi, we're seeing some incredibly fun things happening. Obviously, the advent of Compund Finance and the Comp Governance token, the listing of it in Coinbase, it's tremendously vital for this industry. So we've seen obviously what's happened with Maker, we've seen what's happened with Compound, and we've seen this kind of expansion of this sort of reward token and the unlocked collateral through like the C token methodology. So, we're seeing a lot of really advanced and exciting developments in the space. And it kind of reminds me of like what's happened with like food delivery, where venture capital is kind of giving people like, very inexpensive pizzas. So, I think it's a very funny time in the industry, but also a very exciting one. So, with that, I guess without further ado, I'm just going to have a short message and then we'll introduce our guest. Before we start, if you're interested in Bitcoin and blockchain, please consider clicking that subscribe button and also click the bell so you can get notifications about future videos that I might post. Thank you. So I'd like to introduce my guest, which is Nodar. Hello, welcome for joining us.
Hey guys, thank you for having me, Miko.
Yeah, fantastic. So I guess first things first, I'd love for you to introduce yourself and tell people a little bit about yourself and what you're working on.
Yeah, sure. So I'm Nodar. I'm working on the Zapper. It's a project that's really kind of a grassroots driven effort that started originally as a hackathon in November of last year. And what we're working on is essentially simplifying yield farming opportunities of what you're seeing today. So right now, in order for you to take advantage of some of these yield farming opportunities, you have to go through a couple of different sources, a couple of different interfaces in order to get to that sort of end goal. So we simplify that, package that up into a simple action, and you're able to view all of your DeFi assets and manage them from one place.
That's pretty exciting, actually. So, it brings me to kind of like the real core question, right? Which is there's a tremendous amount of excitement about yield farming. We did in a previous show mention some of the tool chain around it. I think some folks are using things like Instadap, and so what I'd love to get from you is a little bit of a perspective on, I guess for the audience's sake, maybe the first thing first would be, what exactly is happening? One of the quotes that I saw on Twitter that I really enjoyed was someone saying, if you don't understand where the yield is coming from, it's coming from you. Right, which I liked, and that's very much paraphrasing of a famous Warren Buffett quote that is, if you don't know who the mark is at the table, it's you, right? So I think that's a funny way of looking at it. But what I'd love to understand from you is sort of where is the yield coming from, and how does it work?
Absolutely. So different platforms offer kind of different math formulas to offer one side to get yield and the other side to pay the yield, essentially. That's kind of like the simple version of it. But let's take a look at like kind of clear examples. So with Compound, one side is lending, the other side is borrowing. So the borrowing side is obviously the one paying the interest, the one that's paying the yield. In Maker, you are collateralizing some of your assets in order to get a loan. And then you're paying some interest on that loan. Right now, actually, if you're collateralizing ETH and taking out DAI, there's 0% interest. And they're doing this currently in order to incentivize people to mint more DAI into circulation. But in order for you to return the loan when there is interest, you have to return it with some interest in order to unlock the collateral back. And if the collateral drops below your liquidation price, that's when you pay a little bit of a liquidation fee. It's actually not a little bit, it's 13%. So it's another way for where users are paying yield, right, when they get liquidated. In something like Uniswap, if you are a liquidity provider, right, providing your assets to a market where people could then swap them, every time they swap them, they're paying a 0.3% fee, right? And that exchange fee usually would go to something like Binance directly as a corporation. In this case, it goes to the underlying people that are providing these assets, and anybody could provide those assets. So that's another way where like yield is coming from. And now you could start kind of combining all of these use cases, because individually they are kind of like these infrastructural pieces of this new economy, right? This new finance that's open and available to everybody. And therefore, you can access them without kind of asking anybody for permission. So you can move assets and create derivatives on those assets and place them to start earning yield in multiple places instead of just one. So yeah, that's kind of sums up the DeFi sandwiches that you're seeing today.
That's fantastic. Thanks for that. So, with respect to kind of Zapper and Zapper users, like what's the kind of killer application? Like, what's the sort of like most popular use case? I mean, it sounds like what you're talking about is kind of yield farming or yield maximization. So, tell me a little bit more about kind of what makes your offering special.
Absolutely, sure. So yeah, what we started out with, what got really popular, was providing assets to what I was mentioning before, something like where you're to Uniswap as a market maker. In order to do this, you actually need to come with two assets, and they have to be equal worth. So if you're coming in like starting with something like just Ethereum, right? You came into the crypto space. You just bought ETH on Coinbase. You need to then split it up into two different assets depending on which pool you want to come into, and then make another transaction to provide those assets. So it kind of creates a little bit of a user friction there. And what we did was we abstracted those transactions into one, and basically you were able to do this in one action.
Nice.
Yeah, so we've noticed even some people who've been in Ethereum for longer than I have, honestly, they weren't aware of these types of opportunities before. They weren't aware exactly how pooling works. Even though they themselves have been using Uniswap even, so they've never kind of moved over to the pooling section of Uniswap. So yeah, these concepts might be hard to grasp. So what we've noticed is that just improving the user experience a little bit kind of brings a lot more usage to the ecosystem, and people are actually understanding what's happening uh, behind behind their money, right?
That's
Uh,
important.
yeah, and now what we're seeing is, like I mentioned before, is like there's once you provide liquidity, say for one of the Uniswap pools, right? One of the original kind of yield farming opportunities was offered by Synthetics, and it's something that we've immediately provided a nice interface for. So basically, once you provide liquidity to Uniswap, what you get back in return, or something that tracks your assets provided, is one token, and it's a ERC20 token. It's like a Uni V1 LP token. So Synthetics, in order to incentivize people to provide more liquidity to their Uniswap pool, which was synthetic ETH and ETH, right? So now if you think about it, in this case, you're like keeping your full ETH exposure, meanwhile providing assets to a pool that's trading them. So you're just getting yield there. And in order to incentivize more people to provide liquidity so that the slippage incurred is less, what they did is they gave out SNX tokens, right? So basically, they were manually tracking, taking snapshots of everyone who was providing liquidity to that pool, and giving them SNX tokens. And then that pool became the most popular pool in Uniswap V1. It really kind of worked as an incentive. So that was like the original experiment. And yeah, we provided a nice interface that showed you how much SNX you were basically accruing. You were able to do, again, like those actions in one place. Then SNX launched a smart contract, which took those LPs. So you had to deposit the LP into a smart contract, which then literally accrues it as like a CDI, but for pooling opportunity. So it accrues SNX. So yeah, that was another transaction. So again, we abstracted that one. So yeah, it's been kind of fun watching these experiments play out. Right now, there's obviously a ton of them with Balancer, with Curve, and you could do all of this. Yeah, like I said, from one place on Zapper. Uh, yeah, there's a lot of sandwiches coming up, and our ultimate goal is actually to kind of give the power to the people to make these sandwiches themselves, sort of say Zaps. So yeah, you'll be able to make these combinations and deploy them, and essentially even make money from them.
I like it. So I like your use of the term sandwiches. That's pretty fun. I think the one that I've kind of that's been very much popularized is this concept of like money effing Legos, right? So like money Legos, right? So Lego sandwiches, those are all kind of different metaphors for kind of stuff that you build and then you kind of enjoy, right? So, and you can kind of build one out of the parts of another. I would say this, right? Which is that it sounds like you're talking about three very discrete things. So kind of on behalf of kind of the newbies in my audience, like I'd say that the three things to keep track of, like one of the things that he mentioned is like Uniswap and the idea of liquidity pooling, right? So the goal there, and he, what Nodar mentioned is he mentioned this idea that supplying liquidity produces value. And the way it produces value, I think he used the term slippage, right? So the idea of slippage is really simple, which is that, if you put in a large order, right, then pretty much what happens is it affects supply and demand, right? And so if you put like a huge order into an exchange, then your price will start slipping, right? Because people will know that there's way more on the sell side than the buy side, right? So it gets very lopsided and the price starts to get messed around as you so your order doesn't have liquidity and it starts sliding, right? So in some ways, the definition of liquidity is the ability to ensure that there's a kind of a complete stable price regardless of the size of transaction. So in order for decentralized exchanges to maintain liquidity, they actually have kind of liquidity pools. But the thing that has evolved that I think you're mentioning, which is the second thing I wanted to mention, is incentives, right? So you were talking about synthetics, and this is actually a big thing, right? Which is what's happening now is that, most of these tokenized platforms are actually offering users bonus tokens in order to participate either as being liquidity providers or being lenders, right? Because those are the two sources where you have money and you're kind of providing the money in order so that a service can operate, right? So it's either that you're providing liquidity to an exchange or a decentralized exchange, or you're providing kind of basically liquidity to someone to borrow, right? So I just wanted to kind of like run through those quick summaries, but I wanted to kind of bounce it back over to you, to kind of get back into the deep end of the swimming pool. So I think given a lot of these dynamics, it sounds like you kind of got your start in the sort of Uniswap pooling and liquidity world with synthetics. But like, what's new? Like, what are the latest things that you've been working on?
Yeah, so the latest things are definitely with this new automated system for an exchange of stablecoins, specifically called Curve.
Okay.
So yeah, there's a lot of opportunities coming there, and another one is Balancer. So Yeah, basically with Curve, what happens is you are trading. It works in a similar way as Uniswap, but in Uniswap, it's always a pair of two different asset tokens. In here, you're always trading same pair assets. So it's either stablecoin to stablecoin or something like REN BTC to WBTC. So it's literally used as a hub for people to move liquidity between different DeFi platforms. So, for example, you can obviously get mint REN BTC from this new project called REN Protocol. So essentially, you deposit your BTC there, and then in return, you get REN BTC, which is a ERC20 tokenized version of your Bitcoin. So it's done in a fully non-custodial way, and what you can do then is then use that REN BTC obviously to use it within the Ethereum ecosystem. And there's been an explosion right now of amount of Bitcoin that's being minted this way and deposited into Ethereum. So uh, basically, Bitcoin is being put to work on Ethereum. So yeah, it's been fun watching this platform really explode recently with a ton of volume, and we're seeing professional investors come into space to try to take advantage of a lot of arbitrage opportunities. So that's what this creates, and plus you are getting a lot of incentives. So there's a pool right now with Curve where not only can you mine comp, you're also mining BAL token, REN token, and SNX token, and Curve token. So yeah, it's a big one if you're providing liquidity to the SBTC pool. And yeah, again, you could do this from Zapper from one place.
That's amazing. So I guess Curve is kind of new and kind of rapidly rising up and comer. What about Balancer? Can you talk a little bit about that and how it's differentiated?
Yeah, of course. So it's again starting from Uniswap, where you have automated market maker. So again, you're not trading actually against people as market makers. You're literally, it's just a smart contract with a math formula, which keeps a constant product. So that's why you're like incurring that slippage. But with Uniswap, it's limited to only two asset pools. So like as a liquidity provider, you have to again come in as an asset provider and provide a half with both assets as a liquidity provider. But in Balancer, you can create pools and add liquidity with multiple assets in any kind of allocation. So you could think of it as like it flips the concept of an index fund on its head. Instead of you paying like fund managers a fee, you're paying liquidity providers a fee, which are like people themselves, who could be anybody providing this liquidity. So yeah, like you're not limited to just 50-50 pools. There could be 75-25 pool, or there could be 33 pool with something like 3 assets or 4 assets. Yeah, you could go kind of in any way you want. So yeah, in some ways, if you're trying to get sort of exposure to multiple different assets at the same time and become a liquidity provider, or if you are trying to have more of exposure to one side than another, then that's what.
So it's effectively kind of a derivative that provides exposure to different baskets, right? So it's a little bit like a mutual fund type of a model where these kind of decentralized assets each provide exposure to, a unique collection.
Yeah, exactly. And then again, people could come in from the other side as traders and start trading against the liquidity provided there. And the more and more of these platforms come about, kind of the more rigid and robust our ecosystem becomes, because kind of like arbitrage is getting closed faster and faster, and with more and more liquidity, there's less and less slippage. Yeah.
Yeah, how I guess how would you recommend someone to kind of get started? So what's the kind of easy gateway? Like how do people, get the first DeFi exposure, and then kind of how do they learn the more sophisticated things?
Right, for sure. So actually, like even before starting like with Zapper or anything, or with a hackathon, what I started last summer was this thing called DeFi tutorials. It's literally
Yep.
DeFiTutorials.com. And basically, like, yeah, I was also like, I saw a lot of people being skeptical of putting their money into the space because
Yep.
it's like, well, what's going to happen with my money? So literally, I started like making these test drives of people seeing like what actually happens with the money that I put into ecosystem. I have like even like actual transactions that I paste in there. So yeah, like I myself kind of started learning and like making use of a lot of these protocols myself, and that's how I kind of build up a network and got a lot of kind of feedback from users themselves to then eventually build something like Zapper. So I would definitely start with just learning a lot and trying to really understand exactly what's happening behind your money before like kind of jumping in head first and like start depositing your money everywhere. There's another good source would be like ETHub, if you're trying to learn about Ethereum in general. Um, Bankless by Ryan Sean Adams, DeFi Rate. Yeah, there's plenty of good sources. We have them listed. We also have a great documentation section on Zapper in general, kind of explaining each opportunity. Uh, yeah, I have like videos where whenever I kind of have time to make them to explain all of these opportunities. So yeah, and our Discord is very active. If you have any questions, always feel free to jump in and kind of there's
That's
that's
a,
why that's what I said from day one. It's a very community driven effort. So
That's
yeah.
fantastic. That's fantastic. So one thing that I'd love to get from you is sort of like, how do you see the space evolving, and what do you see as being kind of the medium term future, like 6 months, or what do you see as happening over the next year or 6 months of for DeFi?
Right, right. So like I'm seeing a lot of people right now, like I think kind of what you started to show is like at first glance, like yield farming, like optimizing for profitability might look similar to how bankers use like creative accounting strategies to manipulate the markets,
Yes.
like what Lehman Brothers has done and everything.
Yep.
Uh, but actually, it's like the opposite. There's a very clear distinction. Farmers are hacking, and bankers are cooking, right? It's impossible to sort of uh, just go in and change the numbers, right, on the ledger. This is why this is different. And what farmers are actually doing is they're making our system more robust. So anytime you see a hack or something, it's uh, it's better that we discover these as soon as possible before billions and trillions of capital are in the system, right? So I think this is how, like, it's not a black box like it is with bankers, where they could just a handful of people could go in the back and kind of change numbers in an Excel spreadsheet. Here, everything is open and everyone can always obviously double check the work, and you can't game the system. It's literally the math formulas running these
But but
protocols
but
as opposed to people.
so think about it this way, right? Which is one of the things that's really funny about this is that, you know, let's just look at it as like decentralized bank, right? So let's look at it as a bunch of investors investing in a decentralized bank, right? And they're getting rewarded for it. Like, for example, like if you look at something like comp and you look at usage of comp, like you get rewarded in the governance token, right? So in a sense, like if you look at the old style of bank, for opening an account at a bank, you used to get rewards like a toaster. Like they'd give you like, okay, here's your gift, right? So in a way, like you're getting governance tokens, like a reward for opening an account, or it's not really literally for opening an account. But here's the funny thing, right? Which is that when you look at things like a bank and you look at IT security, one of the things that's evolved. So like my friend, Marian actually is a founder of this company called HackerOne, which is basically like a bug bounty or security bounty company, right? But the thing that's so funny about today, though, is that the way you describe this, which I think is a wonderful way, a mindset to look at it, the thing that's so interesting is that if hackers are doing things like draining smart contracts through bugs, right? like obviously what's happening is that there is a bug bounty, which is the reward is the contents of that contract, right? So they're getting a reward, right? And what's happening is the person who lost their money is kind of reporting it to the developers and saying, I'm not sure what happened, but I used to have like 10 ETH and now I have zero, and then the bug eventually will get fixed, right? But the thing that's funny is that the bounty is also being paid in a decentralized way, right? By the people who may have put their assets at risk into contracts that may have not been optimally designed. So how do
That's why
you,
the yield is so high.
but how do you look at it that way? Like, how do you look at that?
Yeah, I mean, this is where we're seeing like a Cambrian explosion, sort of like
Yep.
of these experiments play out. Whereas before, like imagine kind of launching your own money market right now in the traditional finance. It would take you years and millions of dollars probably to go through, right?
Yeah.
But here you could do it. You could deploy it in 5 minutes. So you could test your math formula out if it works in the real world in an economic way. Yeah.
Have there been incidents of kind of self-hacking within the decentralized world, right? Because you could easily deploy a contract that's sort of supposed to do something wonderful and maybe acts initially as maybe something Ponzi-like, and then at some point basically just like uh, is designed to kind of maybe it's not like something blatant where you can see it easily in the code, but maybe there's some kind of complex backdoor that could be put in, right? So it's possible that like, and again, like the people who are draining the contracts, like those in theory could be insiders, right? Like you don't actually know who's doing the draining, right?
Absolutely, yeah, yeah.
So if someone's very clever, they could even be working for one of these major DeFi companies. They could potentially backdoor something into a contract that allows them to drain the contracts, and they could just wait for the largest contract and then drain it themselves.
Yeah, like I said, like new innovations always try to bring like, obviously people who try to scam and stuff.
Yep.
But I think we're gonna see more positive than negative come out of this. So yeah, that's kind of like my view on it. And again, like with each bug discovery, it's just making the system more and more robust. Each bug discovery in traditional finance causes usually trillions of dollars in public uh, loss and trust, right?
Yeah.
So, yeah.
I mean, I think to me, like when I reason about this, like I think that complex financial systems inevitably have different forms of collapse at different scales, right? And that's just an emergent property of such complex systems. So the thing that's really interesting about what you're describing is that it's sort of a stated preference for kind of a very large number of micro collapses associated with a very large number of kind of robust interacting ecosystem components, right? But I do think that like there may be an emergent property for such a complex interconnected system, especially with things like automated liquidation, to potentially experience kind of like very, very big flash crashes. So I don't know what your perspective is on that.
Yeah, I mean, we've seen the recent development actually right after kind of we started kind of really popularizing the concept of composability in the space. We see the concept of flash loans from Aave launch, and it's basically uh, again, like in my opinion, started stress testing the system a lot more and a lot better. So like now anyone can, without any capital, right, could deploy capital to try to take advantage of some of these arbitrage opportunities, or in some cases like drain pools. So what I mean by that is like I mean, have you guys discussed the flash loans at all in
Not
this
much as yet. I mean, I'm definitely aware, for example, that in, Instadap, there's actually the usage of flash loans to do maximum comp farming types of contracts, right? So you can definitely take advantage of those things as a component, but I haven't really specifically talked about flash lending. So I'm interested to get your take on it.
Yeah, so I mean, what happens in the case with the Instadap, what you guys probably described is that kind of like increasing your leverage using one of these systems. So, for example, like when you go into Compound, right, you supply some assets, and then you can only withdraw up to like 66% of its value
Yep.
as a loan, right?
Yep.
But you don't usually do that. You usually take out like 40% of your value as a loan to try to be safe. And now what you can do is obviously buy more assets with this 40%. and supply them back, and basically take out another loan, or supply them to another place and take out another loan. So basically, you're doing these kind of multiple hops combined into one, and creating that. What we've seen kind of a lot of hacks happening from before with something like BZX is with flash loans you can borrow a lot of money, but you have to return it in the same transaction, in the same block, right? So what people have done is they used one place to borrow, another place to place a short bet, a third place to dump a lot of these borrowed tokens that they shorted, to basically then obviously gain a lot more than they have lost on dumping the token. So yeah, that's kind of how they drained one of the platforms which offered one of these leverage opportunities. It's the Fulcrum. Yeah.
This seems like a fantastic opportunity, actually, for some kind of um, sort of an AI or genetic algorithms approach. Where you could have some kind of machine learning based yield maximization methodology.
Yeah, absolutely, absolutely, and that's kind of exactly what, if you think about it, what these modularized smart contracts allow. So, like I said before, these protocols, they kind of offer these core infrastructural pieces that you can use in a modularized way. Like I said, like modularized composability of open finance, and kind of create all of these different derivatives and other opportunities to maximize yield. And again, it's kind of, how in a traditional finance, again, it's a black box. Here, everything is in the smart contract that you can inspect at any time.
So when you were talking about the draining of fulcrum, like you were actually not talking about kind of like a fundamental logical error, but you were actually talking. I mean, you weren't talking about kind of a sort of a bug, a security bug, but rather you were talking about something that was just an inherent property of the mechanic, right? And that it was an exploitation of the inherent mechanic. Is that accurate?
Yeah, basically a price oracle. So there was like a price oracle issue that wasn't able to track the price movement in time on this Fulcrum platform.
That
So
seems
Fulcrum
like a
platform
pretty
was,
common thing, right? Like it seems like that
yeah.
was sort of what happened with Maker and the kind of Black Thursday event, right? Which is that there's sort of a Oracle DDoSing type of thing.
There the gas issue was more of a problem, I think. Basically, people weren't able to like submit transaction to either prop up their CDP in order to make sure they're not liquidated, and people weren't even able to submit transactions to go through to liquidate the CDPs. So that's why
Wow.
some of them got liquidated for at $0 because some were able to submit a proposal to get to liquidate CDP at $0,
Wow.
basically,
Wow.
which yeah, like was definitely an issue. So yeah.
Amazing. Amazing. Yeah. So you see this space kind of like growing pretty materially as a function of all this kind of development work. Um, so I guess what do you see? How if you go even longer term, like what's your prognosis? Like how do you see this like 1 or 2 years out?
1 or 2 years out, I think we will, like definitely have a lot more capital in the space, but we will be, like continuing to, like making the system more and more rigid. Definitely, we're going to see the evolvement of more complex derivatives such as options. I think options will bring actually a lot more stability into the ecosystem. We're not going to see these crazy kind of volatility jumps. It's kind of what options are used for in traditional finance. So yeah, I see the development of and kind of like the usage of more complex derivatives come into play in the next 1 or 2 years.
Nice. And how do you see Zapper? And like, what are your kind of goals for your project? And how do you see that going? And what's your plan?
Yeah, for sure. So we want to really leverage these modularized composability parts of open finance and use token incentives to create a community-owned platform that provides capital introductions and facilitates relationships between new financial entrepreneurs, basically Zap builders, and the end users, Zappers. Right now I'm seeing a lot of already kind of young builders and hackers come to us with ideas and saying, hey, like I have a Zap for this, Zap for that. There's a lot of people who already launched, like kind of what you mentioned before with like automated yield optimizations. This really amazing builder in the space, Andre, he built iEarn. Basically got inspired by our Zaps, and he combined a bunch of them and used basically like an automated yield optimizer in the background that sends out messages to Zaps to get executed, right? So Zaps are like basically you could think of them as like pipes for DeFi.
Yep.
So yeah, like we definitely want to kind of have this platform again that facilitates the relationships between the Zap builders and Zap users, and we want to have Zap builders basically own this platform. So yeah.
Got it. Got it. So really you're looking at it from more of a mindset of kind of like a developer tools platform, but that it becomes kind of and it's basically there's an ownership token representation. Is that how they become the owners?
Exactly. So we'll very soon announce our plans for Zapper DAO. So a decentralized autonomous organization, which would be run by a token and basically would be minted by the Zap users and Zap builders.
That's cool. So basically, what happens is that people who are contributing Zaps are kind of proportionally rewarded. Are they rewarded for kind of the usage that their Zap kind of provides? Does the Zap token function also as kind of a network gas, or is that a separable issue?
Yeah, no, it doesn't. It's not about network gas. It's yeah, literally what you said. They'll be able to earn the fees that their Zap provides to the ecosystem. So essentially, actually the Zap users themselves also will be earning a part of the ownership of the platform. Uh, so yeah, it has a couple of interesting positive um, positive loops, feedback loops that we're planning to
That's
implement through
fascinating. What
the
about in
ecosystem.
is there are there reward mechanics like you would see in a comp, or what's your perspective on reward
Yeah,
mechanics?
exactly. So anytime basically a Zap is used, a bit of this Zap token would be minted to the Zap builder of the Zap and the Zap user.
How
Yeah.
do you envision the kind of like minting supply? Like how do you see that? Do you see that more as kind of a potentially expandable thing like an ETH, or do you see it as like a limited thing like a Bitcoin, or what's your mentality about the kind of minting sort of curve, as it were?
Right. So as of right now, we're considering a finite supply, but what we ultimately want to do is have again this DAO this make the decisions. So the community making these decisions, not like kind of me making a decision or you or anybody else, but kind of putting their token as a community member to make this ultimate decision. So
Here's a
yeah, like,
question though: is doesn't that add even a more kind of doesn't that add sort of meta instability, right? Because in theory, it enables people people might be able to sort of attack the system as a function of owning a good bit of your token, and
which
not in a not
yeah.
in a way that ruins the thing altogether, but maybe in a way that kind of drives their own monopoly power.
Absolutely, which is why it's crucial to properly set up the governance from the get-go, right? So, and kind of uh, grow it very organically from grassroots. So what I mean by that is like kind of like uh, we see a lot of projects in the space, raise a lot of VC money and then try to kind of launch a DAO token. That doesn't seem very community owned to me. still a handful of people making the ultimate decision. So yeah, like it's very important to start right, and yeah, like at the end of the day, it is an experiment, but it's definitely one we're excited to do.
Yeah. I mean, it's exciting. It's definitely a complicated topic, obviously, right? Because the thing that becomes really interesting is that what we see happening in kind of so-called free markets is typically in so-called free markets you tend to see kind of an 80-20, where you generally see sort of a dominant sort of pseudo monopolist that essentially absorbs about 80% of the total market share, and then you see this kind of metastable construct of like an aggregate of players that sort of soak up the rest of the 20% of the market, and obviously like different markets have very strong differences in the way that they metastabilize. Like, if you look at something simple like Coke and Pepsi, you may actually end up seeing something more like a 50-50 rather than an 80-20, because there aren't that many material network effects inside of Coke and Pepsi. Like, it's more like brand and price, and it's much more kind of a simple commodities market as opposed to something that has kind of network effects, right? So if you see a system with network effects, for example, like a developer platform, in a developer platform, you would actually expect to see these dynamics of like having a dominant provider, right? So if you look at things like social networks, like those are the kinds of markets where you see kind of almost kind of utterly dominant monopolies arising, right? So to me, those are kind of considerations as you start to sort of build the governance structure of this sort of emergent, decentralized, autonomous organization. So, those are definitely serious considerations. One of the reasons why I'm kind of poking here is that, we have seen decentralized organizations with very unusual behavioral properties, like things like, when you look at proof of stake, the role of centralized custodial exchanges in aggregating user stake for the purpose of, so they've separated the economic layer from the legal layer of ownership and custody, and then they separated that from the voting layer, and that allows these organizations to kind of aggregate a disproportionate share of votes. So, I don't, since you're not a proof of stake system, like, you're not going to have those dynamics, but I, what I would propose is that, you might end up with like a winner take all type of scenario, in the case of like, if you have an early mover that starts to kind of like gain a momentum, that could potentially end up being a network takeover of some sort.
Yeah, absolutely. Yeah, which is why I said it's like crucial to watch for governance from the very beginning and make sure you're not starting with already one side like owning a bunch of it. And
but I think even if I agree with you that any nonlinear system should have an exceptional kind of sensitivity towards the initial condition, but the mere fact of its extreme nonlinearity suggests that the end state and the beginning state aren't predictable, right? So I think the problem with that kind of construct is that I realize you're being very sensitive to decentralization in the initial period, but another way of looking at it is if you could look at it as a scientific experiment with bacteria where you have a petri dish, right? So the idea of having this petri dish, at some point it's possible that some super bacteria will basically kill all the other bacteria, and in a similar way, it may just be, because what you're really talking about in DeFi, I think you mentioned a Cambrian explosion metaphor, is absolutely this almost biological degree of evolution, right? So the idea of a super bacteria is really just one that competes really well for resource, right? And in this case, the resource is essentially deposits, right? So if there's something that provides like an exceptional yield, it could kind of become a monoculture, and it could really kind of like take over. Now, the question then becomes like, why is that bad? But I can tell you why it might be bad is that, what you could argue is that such a creature should not then reward itself with an unfair reward of your token, right? So, and what happens at a certain point is if such a creature rewards itself with too much of your token, then it starts to kind of deflate the value of your token for everyone else, right? And so the question becomes like, what's the extent to which someone like that can start to kind of like really decrease the value of your token relative to something else, right? Because at some point what will happen is someone will take that code and they'll release it on a separate platform, and then they'll compete with your platform, right? So all of this stuff is really beautifully handled by open source, but I think with kind of your network's kind of future in mind, you know, ideally, you know, you would be able to have some kind of like structure that enables, you know, and supports competition and diversification from that point.
Yeah, absolutely, absolutely. Some interesting points you mentioned there, and I guess like one of the things that's building out that we're building out in the space as a moat is like you could like kind of fork the code, but you can't fork liquidity and you can't
Yes.
fork
Yes.
network effects,
Yes.
and that's why like again we're like a grassroots projects that's really community driven, and I think at the end of the day, all these math formulas, everything is people behind them, right?
Of
So
course.
yeah, as long as you know you have again like actual true networks and non bots, then I think that nobody can fork that. Yeah,
That's
overnight.
fantastic. Well, I'm really excited to have this conversation with you. Thank you for adding so much expertise and so much interest
No.
to this show. And you know, I think we're. I guess, do you have any other kind of final words of advice for people getting
Yeah,
into DeFi?
yeah, I was just gonna say like, yeah, thanks for all your kind words, but I definitely don't consider myself an expert, and nobody should. Things change every day here, and yeah, it's good to remain humble and keep this as a learning experience, not come in with some kind of expertise mindset, even if you have a strong finance or programming background. So yeah, it's definitely like. Uh, like learn before you kind of jump in head first.
That's wonderful. Great advice. Terrific. And I think the best way to learn is maybe play. So, like, you know, definitely everyone, you know, you should definitely check out Zapper and Zaps and all of the resources, you know, that Nodar mentioned. We're definitely like the DeFi tutorials. We're going to put the links in the comment section below this video. So, you know, hopefully you'll be able to enjoy those. So, I guess I think I'm going to sign off. So I just wanted to really give my thanks, and you know, it's really appreciate your time. I think this has been a lot of fun for me and really a great exploration.
Thanks. Same here. Thank you, Miko.
Okay, take care.